Welcome to Section 4 of the ASC 225 Income Statement Training for PNJ Group. In this section, we move below operating income and examine the non-operating items that bridge operating performance to the income before tax subtotal. Understanding these items correctly is essential for accurate income statement presentation and GAAP compliance. By the end of this section, you will be able to define non-operating items and explain why they appear below operating income in the multi-step format. You will apply the correct presentation rules for interest, investment results, and foreign currency items. You will also explain equity method income under a SC 323, understand the required income before tax subtotal, and recognize that extraordinary items no longer exist under GAAP, and what to do if you see them on a client's statements. Think of the income statement as a story told in two acts. The first act, operating income, captures what the business was built to do. The second act covers everything else. Non-operating items are revenues, expenses, gains, and losses that arise from activities peripheral to the entity's primary operations. They appear below the operating income line in the multi-step format. Because these items can distort perceptions of core profitability, separating them clearly is fundamental to transparent financial reporting. Interest expense represents the cost of debt financing, and it carries specific presentation rules that trip up many preparers. First, do not net interest income against interest expense unless very specific netting criteria are satisfied. They are almost always presented separately. Second, if an entity capitalizes interest under a SC 83520, typically for self-constructed assets, the capitalized amount must be disclosed in the notes. Gross presentation preserves transparency and gives financial statement users the full picture of financing costs. Interest income, earnings on cash and short-term investments, must be presented separately if it is material. Do not fold it quietly into a catch-all line. For investment gains and losses, classification is everything. Trading securities produce mark-to-market gains and losses that hit the income statement each period. Available for sale and held-to-maturity securities generate realized gains and losses when sold. The investment category under a SC 320, 321, and 323 determines how and when those results flow through income. So getting the classification right upstream matters enormously. When an entity holds monetary assets or liabilities denominated in a foreign currency, a receivable in euros, a payable in yen, exchange rates move, and that movement creates real economic gains and losses. A SC 83020 requires remeasurement of those balances at period-end rates, with the resulting gain or loss recognized in income immediately. This is different from translation adjustments, which affect other comprehensive income. Foreign currency transaction gains and losses belong in the non-operating section and should be clearly labeled so users understand their source. Under the equity method, an investor with significant influence over an investee records its proportionate share of the investee's net income or loss each period, not just dividends received. A SC 323 governs this treatment. The resulting income or loss is typically non-operating because the investee is a separate entity, not part of the investor's core operations. One important exception: if the investee operates in the same line of business, equity method income may be classified as operating. Make sure the classification is consistent and documented. Other income and expense is a legitimate category, but it is frequently misused as a dumping ground for items preparers do not want to explain. GAAP requires that each material item within this category be described, either on the face of the statement or in the notes. A large, vague other income line is a red flag in any review. If you encounter unexplained balances, ask what they contain. Aggregation is only appropriate for individually immaterial items. Transparency here protects the entity, and protects the users who rely on these statements. Income before taxes is not optional. It is a required subtotal under US GAAP. The formula is straightforward. Operating income plus or minus all non-operating items equals income before taxes. Why is this subtotal so important? Because it lets financial statement users apply their own assumptions about tax rates. Analysts modeling a company may use a different effective tax rate than the entity actually incurred. By presenting income before taxes clearly and separately, you give users the flexibility to do their own analysis. Never collapse it into the tax expense line. Before a SU 2015-01, entities could carve out unusual or infrequent items as extraordinary, presenting them below the line, net of tax, with special disclosure. That category no longer exists. Every item, no matter how unusual or how rare, must be presented within income from continuing operations. A separate line with a description and note disclosure is permitted for significant unusual items, but net of tax presentation below the line is not. If you ever see extraordinary items on a client's income statement, treat it as an error, reclassify immediately, and bring it to your team lead's attention. Interest expense is non-operating for most entities, but not all. Financial institutions and real estate companies often classify interest as an operating item because lending and property financing are their core businesses. For industrial and commercial entities, however, interest on borrowed funds is a financing cost, not an operating one, and must be classified as non-operating. Whatever policy an entity adopts, it must be applied consistently from period to period. If you are unsure how to classify interest for a specific client, check the entity type and prior year treatment and document the rationale. Let us bring it together. Non-operating items sit below operating income and capture results from activities peripheral to the core business. Gross presentation of interest is the rule, not netting. Investment gains and losses follow the ASC 320, 321, and 323 classification framework. Foreign currency transaction gains and losses are recognized immediately under a SC 830-20. Income before taxes is a required subtotal, never omit it. Extraordinary items are gone under a SU 2015-01. If you see them, escalate. An interest classification depends on entity type, applied consistently. Thank you for completing this section on non-operating items and income before tax.